challenge for our generation is to create a world where everyone has a sense of purpose.
And you will make a difference in the world.
More than 40 million Americans have federal student loans.
$1.5 trillion in federal student loan debt.
$112.
$47,000.
$90,000.
$35,000.
$350,000.
Higher education in the United States has historically been seen as the key to success. It's a promise to a better and brighter future. Do well in school, get a good job, make more money, and all your dreams will come true. But for millions of Americans, the reality is very different. Instead of prosperity, lobster for dinner, and fancy BMWs, people are weighed down by staggering amounts of student loan debt after they graduate. And today, 43 million Americans owe a collective $1.77 trillion in student loan debt, and that's still growing. And that's about 13% of the US population. So how did we get here? Why has it become so difficult to pay off this debt? And more importantly, what can be done to solve the crisis of student loan debt? First, let's go back to the history of higher education to understand how debt became the issue that it is today. In the late 19th and early 20th centuries, college was reserved for the wealthy elite. But after World War II, the GI Bill changed that. This provided millions of veterans with the opportunity to attend college, leading to a dramatic increase in college enrollment. And by the 1950s and 1960s, higher education was seen as a pathway to the American dream, and many public universities were either free or highly affordable for the average American. And one president after another expanded the program. In 1965, the Higher Education Act was signed into law by President Lyndon B. Johnson, which created federal student loans which were intended to make college accessible for everyone, regardless of financial or socioeconomic background. Nixon launched Pell Grants with Sallie Mae, and Clinton shifted loans from banks to have them come from the government. The idea and belief was that education was an investment for the future for both aspiring individuals but for society as well. And as much as the intentions were good, and the programs would work conceptually, it didn't consider that the prices of college would explode.
Increased by 169%.
Wages are not keeping pace with those skyrocketing tuition rates.
Because fast forward today, the American dream has become a nightmare for many. The cost of college has skyrocketed, and according to the National Center for Education Statistics, the average cost of tuition, fees, room and board at a public four-year institution has more than tripled since 1980 when adjusted for inflation. In 1980, attending a four-year public university cost around $2,500 annually, but by 2020, that figure has increased to over $22,000. And not to mention, private institutions which are even more expensive, with the average cost exceeding $50,000 per year for many top universities. And one of the key factors that caused an increase in college price was after the 2008 financial crisis, states began reducing funding for public colleges and universities. And a decline in funding only meant an increase in tuition to make up for lost funds. And higher tuition means more student loan debt. And on top of this, colleges began ramping up spending to increase the amount of amenities like ball pits, rock paper scissors clubs, and climbing walls. All of this to lure out-of-state or international students to their schools since they're able to charge tuition almost 3 times higher. And even as tuition increased, students kept applying and borrowing, which in turn increases tuition even more. And this creates a vicious cycle, which leaves students with an extremely high amount of student loans. At the ripe age of 18, when only half of kids have credit cards, you're essentially committing to decades of debt, which is a huge burden for anyone to take on. The increasing cost of higher education has forced many students to rely on loans to pay for their degrees. But the double-edged sword is that student loans don't just cover tuition, but they also pay for housing, books, and other expenses, which means that debt adds up that much more quickly. And according to the Federal Reserve, the average student loan borrower owes about $37,000 after graduation, but for many, and even more recent graduates, that number can be much higher. Nearly 7% of borrowers owe over $100,000 in student loans. So why is it so difficult to pay off student loans? Well, there are a few factors. First are interest rates. Federal student loans typically have lower interest rates than private loans, but even with lower rates, like any interest, it compounds over time. That means if borrowers make regular payments, much of their payment goes towards interest, rather than the principal balance. For example, say you have a borrower with $50,000 in loans with a 6% interest, they'll pay nearly $17,000 in interest over 10 years, and this is assuming that they make consistent payments. And speaking of interest, if you're finding this video useful, interesting, insightful, please consider leaving a like and subscribe. It'll help the channel tremendously. Thank you very much for watching. And next is stagnant wages. While cost of college has soared, wages for many entry-level jobs haven't been able to keep pace. Inflation-adjusted wages of young workers barely increased since the 1970s, despite the rising cost of living. The problem is that wage stagnation or lack of higher pay makes it harder for recent graduates to cover basic expenses, let alone make a dent in their student loans. And for student loans, there's an array of different ways to repay. Income-driven payments were introduced as a way to help borrowers manage their payments by basing them on their income. But the plans often extended the repayment period to 20 or even 25 years, meaning borrowers are in debt for a much longer time. Even though these plans offer more short-term relief, they require more interest to be paid over time. And it's no question that a lot of borrowers struggle to keep up with payments, which lead to delinquency or even default. Around 15% of borrowers are in default, and defaulting on a loan damages your credit, which means it's that much more difficult to buy a home or a car. And you actually have a better chance of declaring bankruptcy by losing all your money at a casino. And as much as student loan debt affects individual borrowers, it also has a wider economic consequence. A 2020 survey found that 51% of student loan borrowers said that their debt delayed them from purchasing a home. Therefore, young adults are delaying getting married, starting families, and saving for retirement. And in a way, student loan debt is reshaping the trajectory of entire generations. Millennials in particular are entering middle age with less wealth and more debt than previous generations at the same point in their lives. And you might think, there are all sorts of programs out there for student loan debt. Many years ago, the government made a promise to borrowers to work in public service for 10 years, make valid loan payments for 10 years, and the education department would forgive the leftover balance on the loan. And although in recent years there's been billions of dollars in student loan debt that have been forgiven for certain groups, and so far the Biden administration has canceled nearly $144 billion in federal student loan debt. And a lot of eager borrowers are still waiting for forgiveness, but the reality is that it may never happen as there's a lot of political layers that prevent more widespread forgiveness. The reality now is that almost no one is getting their loans forgiven. Out of 29,000 applications for public service loan forgiveness, only 289 applications were approved, which is a 99% denial rate. And the same thing is happening with income-driven repayment plans. If your income was below a certain level and you made 20 to 25 years of repayments, your loan would be forgiven, supposedly. But it wasn't forgiveness, it was forbearance, which puts a pause in repayments but interest keeps accruing. And a report showed that only 32 people ever received actual student loan cancellation through IDR. Student loan servicer Mohela sent the wrong bills to 300,000 borrowers and late billing statements to 2.5 million people. And these billing delays caused 800,000 borrowers to become delinquent on their loans. As much as it's an uphill battle with servicers and we're waiting on Congress and the Supreme Courts to allow for more widespread relief, it's advised to readjust your life and pay off high interest debt. Because the longer you wait for student loan programs and the longer you take to pay off your debt, the longer you're also putting a pause on the rest of your life. Remember that high interest loans cost more over time, so prioritize paying your student debt first. Track your spending and create a budget to see where your money is going to figure out how much extra money you can allocate to student loan payments. That means eating out less, including McDonald's, not going to Disneyland, and doing everything you can to pay off your student loan debt as quickly as possible. And if you can, pay more than the minimum. By paying more than the minimum required, you reduce your principal faster, which reduces the amount of interest you'll pay over time. Even if it's just small extra payments, it can make a huge difference. And of course, increase your income. Start a side hustle, pick up a part-time job, or freelance work to increase your income. The student loan crisis didn't happen overnight, and it won't be solved anytime soon. But with the proper discipline, you can turn your higher education into success and not a burden. So use the right approach and prioritize your debt so you can live your life. Even if it means no McDonald's and no Disneyland. So check out the next video on how the happiest place on earth has become so unaffordable for so many people.